Okay, looks like we're going stuff. Okay. Picking up where we left off, we were on question number 8 of handout number 11. And in our question number 8, we have XCO, which is a CCPC, has acquired capital property for use in its business at a cost of $1,000. In 2021, XCO sells the property for $2,000. So the question asks, first of all, what amount is included in XCO's RDTOH? So in this case as well, because we're looking at a capital gain here, as the problem sort of gives away, we'd be looking at non-eligible refundable dividend tax on hand in the post-repeal world that we currently live in. So ignoring that distinction between non-eligible RDTOH and pre-repeal RDTOH, in our example, when XCO realizes the $1,000 capital gain, which is the difference between the $2,000 proceeds of disposition and the $1,000 adjusted cost base of the property, realizes the $1,000 capital gain, and of that, again, because of our 50% or 1/2 inclusion rate in Section 38, $500 of that becomes a taxable capital gain. And again, the definition of aggregate investment income in subsection 129(4) includes our net taxable capital gains over allowable capital losses. There's no capital losses in the picture. So the $500 goes into aggregate investment income. So we know that on this $500 of aggregate investment income, XCO is going to be liable for tax of $233.33, give or take some fractional cents, by virtue of the combined operation of subsection 123(1), subsection 124(1), subsection 123.4 sub 1, and section 123.3. And we also know that 30 2/3% of our taxable capital gain, which should be $153.33, gets added to the XCO's RDTOH, or again in post-repeal world, non-eligible RDTOH, at the end of the taxation year under, in pre-repeal world, subsection 129(3), and in post-repeal world, under the non-eligible refundable dividend tax on hand definition in subsection 129(4). So that's where we're at there. Then the question moves on to ask, how does XCO get about recovering its refundable dividend tax on hand in full? And as I think we've covered now reasonably thoroughly, the way that XCO gets the refundable dividend tax on hand back is to pay a taxable dividend, and in post-repeal world, to pay a non-eligible dividend. And it does this by paying a dividend of $400. And that should be 2.61 times its balance of $153.33. And so therefore that should be its dividend refund under subsection 129(1). And as a result of paying that $400 dividend, XCO's corporate tax payable should be reduced to $80, which is 16% of the taxable capital gain. Everybody okay with question 8? Jacob.
Just to double check, so in the pre-repeal language, it's just we call it like a taxable dividend, and then in the post, now that it's like been repealed, we call it a non-eligible dividend for like dividend.
Yeah, what we're going to see is that the way the repeal worked, the reason why we segregated into eligible and non-eligible dividend tax on hand, but you're going to see when we get to Unit 6, is there's two kinds of taxable dividends, and there have been two kinds of taxable dividends since about 2006. One is an eligible dividend, one is a non-eligible dividend. And the reason we segregated RDTOH into two pools was because what finance didn't like was that people were generating they were generating GRIP, which I don't think we've talked about that yet, which allows people to pay eligible dividends. And they were using the eligible dividends to recover RDTOH. And so the result was that since eligible dividends are taxed at a favorable rate, that people were recovering in pre-repeal world, recovering RDTOH using eligible dividends, and so they ended up with a combined effective rate that was lower on investment income than, substantially lower than the top marginal rate for personally earned investment income. And so that we didn't like that. So by dividing RDTOH into non-eligible RDTOH and eligible RDTOH, we made it so that any amount that goes into non-eligible RDTOH can only be refunded by payment of a non-eligible dividend. Whereas in pre-repeal world, any taxable dividend would recover RDTOH without regard to whether it was eligible or non-eligible. And now eligible RDTOH can be refunded by the payment of either an eligible dividend or a non-eligible dividend, but only very specific amounts go into eligible RDTOH. And by and large, for most of this course, we don't really care about the stuff that would go into eligible RDTOH. So, I guess to answer your question, it's not that it's not that the dividends changed. It's just that the types of dividends pre and post repeal are the same as they always were. It's that the RDTOH concept changed to require specific types of taxable dividends be paid in order to recover specific types of RDTOH.
Okay, thank you.
No problem. And I think as you're seeing now, this is why we try to tack more closely to the pre-repeal rules, because the post-repeal rules can get a little bit stupid in a hurry. So anybody else on question 8? Okay. Seeing none, we can move to slide 10, which deals with question 10. We're skipping question 9 because, like I said, I don't really want to deal with the taxable income limitation on, or I didn't really want to deal with the taxable income limitation, et cetera, on section 123.3. So we're skipping question 9, and we will just never come back to it because I just didn't want to deal with it. So question 10. So in question 10, we have Exco has $100,000 of active business income, $10,000 of interest income, $20,000 of taxable capital gain, a $10,000 net capital loss, a $10,000 non-capital loss, and a charitable donation of $10,000, all of which get deducted in 2021. So I guess I kind of lied a little bit. We are sort of dealing with question 9 just by extension in question 10. So I was asking what amounts get included in Exco's RDTOH. Again, this is pre-repeal RDTOH to post-repeal non-eligible RDTOH for its 2021 taxation year. And then we're asking about its small business deduction base. So 2 parts, and this one has some more moving parts to it than the previous questions had. So we can start working through this. So first step, as I see it, is we want to, we have these net capital losses. And so they reduce the paragraph A amount in the subsection 129.4 definition of aggregate investment income, because that capital loss gets netted against our capital gain. So we had an allowable capital loss of $10,000. We had a taxable capital gain of $20,000. So we should net those, and that should take our aggregate investment income down from $30,000, which was $20,000 of capital gain plus $10,000 of interest. That should drag us down $20,000 now, of which $10,000 would be taxable capital gain and $10,000 would be interest income. So that's good. The next thing we want to do is we got to figure out what we're doing with this net capital loss. Sorry, not net capital, it's the non-capital loss of $10,000. Which is deductible from computing taxable income under paragraph 111(1)(a), and our charitable donation, which gets deducted from taxable income under section 110.1. So in our example, we now have taxable income has dropped from $130,000 in problem 9, which is the base case problem. It's dropped now to $100,000. As a result of applying these losses. So then, now that we've figured out our taxable income, after we've done all of that, final step is to determine the corporation's tax payable, which actually requires us to figure out what's happening with the small business deduction base first. And this is why we're probably not going to see a problem like this on the exam, because it's kind of a pain in the ass. But anyway, the first step is actually to answer the second question, which is to determine the small business deduction base, since we have to do it anyway. So under subsection 125(1), as you'll recall, the amount of the corporation's small business deduction is equal to the lesser of the three amounts in subsection 125(1). So we have paragraph 125(1)(a), which is the corporation's income from an active business carried on in Canada, which in this case is $100,000. We have paragraph 125(1)(b), which is the corporation's taxable income subject to certain adjustments, but here it's just taxable income, which is also $100,000. And our business limit of $500,000, which is obviously higher than the other two, so we can just disregard the business limit limitation. So we know that $100,000 of income in our example is going to be taxed at the small business rate of 11%. And so that's going to generate corporate income tax payable of $11,000 when we do that. And so with that in hand, we know that all of our income has been taxed at the small business deduction rate. So there's no other income that's going to be subject to tax at other rates, right? Like that, there's nothing left to tax. So then we can figure out what we're going to do with our RDTOH now. And so with our RDTOH, you'll recall that or if you're following along with your ACT, you'll see that it's the lesser of three amounts. So the first is 30 2/3% of the corporation's aggregate investment income for the year, which is going to be $6,133.33 in this example, since we had $20,000 of net aggregate investment income. Or it's 30.67% or 30 2/3%, again, however you want to express it, I don't really care, of the corporation's income in excess of its small business deduction amount and its foreign tax credit sheltered income, which is nil, because in this case we have no income in excess of our small business deduction amount. Or paragraph C, the corporation's tax payable for the year, which is $11,000. So since our amount 2 is nil, right, because the corporation had no income in excess of its small business deduction limit for the year, then that would mean that no amount gets added to RDTOH in this example. So even though we have this aggregate investment income, we have no amount to add to RDTOH. And for the reason that we've canvassed already, when we tried to sort out the small business deduction base, nothing happens to the small business deduction base. It basically ends up where it always would have been in this fact. Even if we had stripped out all of the losses and charitable donations and investment income, our business limit would have been $100,000, and it has remained at $100,000. So what you can see here is that just the way effectively the Act creates ordering rules, right, with these limitations on taxable income, but then these limitations on limiting amounts to the excess of amounts over the small business deduction limit. And the overall effect is that where you have non-capital losses carry forward, or you have amounts that get deducted from taxable income rather than getting deducted in computing any particular source of income, is that those amounts are effectively going to be charged against the high rate income first and the small business deduction income second. So in this case, where we had enough deductions in computing income to effectively run our aggregate investment income to zero, the result is that all the income gets taxed at the small business deduction rate. So that's a pretty acceptable result for most people. Everybody okay with that? Okay, assuming so, we can then move on to slide 11. And in slide 11, we're on to question 11 of handout number 11. And this is asking us about a change in status of a corporation. And what does that change in status, what would the effect of the change in status be on the RDTOH account of the corporation? So, the first thing you should identify here is that the phrase change in status that's used in the handout is very vague, right? So you need to know which status is changing, because not every change in status will in any way affect the RDTOH balance. And I mean, you'll also recall that the definition of RDTOH, or generally speaking, the definitions of non-eligible RDTOH and eligible RDTOH apply to every corporation and not just private corporations. So in fact, a status change might not impact RDTOH at all, right? But there are a few different things that might happen. So first of all, if the corporation ceases to be a CCPC, what that would have done in the pre-repeal world is it would have prevented further amounts after the change in status from being added to RDTOH under paragraph A of the RDTOH definition, which is the one that deals with aggregate investment income. You would have had no additions anymore to that paragraph. And that generally tracks through into the non-eligible RDTOH definition in the post-repeal world as well. The second change, and again, we talked about this, is the more significant change, is that if the corporation ceases to be a private corporation, in that case, you have a couple things will happen. First of all, like we talked about, the corporation loses its ability to obtain a dividend refund under subsection 129(1), and because it's no longer a private corporation. And so if you're going to try to recover RDTOH, again, you've got to do it before you lose private corporation status. The other change, and this is somewhat subtle, is that if you look at the former paragraph 129(3)(c), you're going to see that potentially the RDTOH balance won't be carried forward after the change in status, because the corporation will no longer be a private corporation at the end of its preceding taxation year. So at some point, your RDTOH carry forwards, not just your ability to recover the RDTOH by paying a taxable dividend, but just the RDTOH carry forwards as well. If you had a balance in the pool, that's going to drop away if you've been not a private corporation for long enough. So then how does this get alleviated? And, you know, obviously, I think what should be reasonably apparent is that there isn't much alleviation that needs to be done when you have a change in status from a CCPC to a non-CCPC. Subsection 129 3.1 will deem there to be a year end at the time of the change in status. So there isn't really any potential to lose RDTOH by ceasing to be a CCPC but remaining a private corporation. So basically all of the investment income that was earned up to the time of the change in status is going to be included in income in the taxation you're ending immediately before the change in status, and so still gets added to RDTOH or non-eligible RDTOH immediately before the change in status under paragraph 129.3a or under paragraph A of the non-eligible RDTOH definition. But that's basically it. And after that, you just don't add any more amounts. But you also don't get taxed on investment income the same way as CCPC does anymore. So that's actually a net win on balance for the corporation. So there's nothing you need to do to alleviate there. Again, the bigger deal is ceasing to be a private corporation. That is something where you need to alleviate. And like I said, the solution there is as long as you're cognizant that you might lose your private corporation status and you're cognizant of when that loss of private corporation status is going to occur, what you need to do is figure out your RDTOH balance or your non-eligible refundable dividend tax on hand balance or eligible RDTOH balances, as the case may be, immediately before the change in status. And you need to pay sufficient dividends to recover all of that RDTOH before the change in status happens. That's the main alleviation tool. If the corporation is still a CCPC at the time you're looking at potentially losing status as a private corporation, what you will also want to do is you want to take into account that there's going to be a deemed year end on the loss of CCPC status, and that there's going to be further additions to RDTOH if the corporation is earning investment income in the taxation you're earning on the change of status, and you probably want to estimate what those amounts are and gross up your taxable dividends accordingly. Okay, so if we flip to slide 12, we're now on question 12 of handout. We're on question 12 of handout 11, and in our problem, we have two associated CCPCs. And so these two CCPCs enter into a lease whereby one corporation leases the business premises from the other for basic rent of $500 per month plus 10% of all income in excess of the lessee's business limit up to a maximum of $100,000. So for fiscal period 2021, both calendar year taxpayers, profit participation is the maximum of $100,000, which means that we would have $500 a month, so that's $6,000. So we have $106,000 of rent that was paid from one corporation to another. And so, Raj, what are the income tax consequences of this arrangement for the 2021 fiscal periods of the two corporations? And in particular, look at subsection 129.6 and what is the purpose and effect of this provision. So, starting with the first question, the result for the lessee corporation is pretty straightforward. Again, we're assuming it had a full business limit of $500,000 given the wording of the problem and the fact that it kicked out $100,000 of additional rent. So we know that what's going to happen is that it would have had at least $100,000 of full rate taxable income. And let's assume it has $106,000 of full rate taxable income just to make it nice and easy. So it's going to get a deduction from its full rate taxable income of $106,000. And because all of that amount is, we're assuming in excess of its small business deduction, in excess of its business limit, there's no effect on its small business deduction base. So although the corporations are associated, presumably they've allocated all of the business limit for the associated group to our lessee corporation. So lessee corporation is still going to have a full small business deduction, and it just gets this deduction for the rent paid that it's going to take against its full rate taxable income. So that's great. Then the more interesting part of this from the perspective of the topic that we're discussing is what happens with the lessor, which is the person who's receiving the payment under the lease. So you'll recall that I mentioned a few times that rents are typically income from property, or they're typically income that's earned in the course of a business, the principal purpose of which is to derive income from property. And we'd say, well, therefore, typically rents would be aggregate investment income, and they'd be subject to our refundable tax, and they'd get added to non-eligible RDTOH or pre-repeal RDTOH, and they'd get refunded upon the payment of taxable dividends. But that would all be very bad in this circumstance, right? Because if we didn't have the rule, we'll talk about that actually in the second part of the problem, what would happen if we didn't have the rule, but it would be very bad. But that's not what happens, okay, because this is where subsection 129 sub 6 comes into play. And what subsection 129(6) does is because the corporations are associated and the lessee corporation was entitled to deduct the rent in computing its business income, then subsection 129 sub 6 is going to apply. It's going to deem the rental income to not be aggregate investment income under subsection 129 sub 4. And it will furthermore deem the rental income to be active business income for the purposes of section 125. So in this case, the second part of subsection 129 sub 6 doesn't actually really matter, because the fact that it's deemed to be active business income for the purposes of section 125, we don't really care. Because again, we've assumed that the associated group is allocating its entire business limit to our lessee corporation, which had the $500,000 at least of business income in the year. So it's not like we're going to somehow get more small business deduction for our lessor corporation as a result of the income being deemed to be active business income. However, if the associated group is not using a full small business deduction, then it would be possible to allocate some business limit to our lessor corporation, and the lessor corporation would be entitled to the small business deduction in excess of the rent, in respect of the rental income. The really big piece of this is subsection 129(6) deeming the rental income to not be aggregate investment income, as defined in 129(4), with the result that the rental income just gets taxed at regular rates. So either if it's not the small business deduction rate, it's just the general corporate rate. And that brings us nicely into the policy rationale, the why is this the case part of the problem. And again, the answer here is to allow for neutrality, right? Because we know that for corporate commercial purposes, there are very good and valid reasons why it may be that assets are owned by a different corporation than the one that actually uses the assets in its active business. And so if we didn't have a provision like subsection 129(6), and we just had this situation where a corporation that carries on an active business and deducts rental payments from that it's making to an associated corporation, gets a deduction from business income, but the associated corporation gets whacked with investment income, it's going to lead to commercially stupid results, right? Like, for example, you would have a pretty good incentive to make sure the building, in this case, is in the same corporation that carries on the operating business, which your corporate commercial lawyers probably aren't going to like very much, since the real estate is a valuable asset that could be sold separately from the business, and you wouldn't want to expose it to business risk if you didn't have to. Or you're going to have stupid arrangements where the corporation that doesn't own the building is going to lease it for like $1 a year or something like that, which doesn't make a lot of commercial sense. But we're now just distorting the commercial result in order to fit into a tax result that we like better. So not ideal, right? So that's handout 11, and that's the end of question 12. Did we have any questions there? Okay, so if we can flip to slide 13. Slide 13 covers what I've been sort of alluding to throughout the day today, which is that the present day refundable dividend tax on hand regime is not the same as it was pre-repeal. So like we talked about pre-repeal, and sort of as Jacob got to in his question earlier, pre-repeal, any RDTOH could be refunded by the payment of any taxable dividend, whether that dividend was eligible or not eligible. So this led to a structure that people would call like a corporate mixer or a corporate purifier structure. And the way it would work would be like, suppose that you have a shareholder, and shareholder has investment assets and business assets. And investment assets generate a bunch of investment income, and business assets generate more than $500,000 a year of business income. And suppose shareholder needs some amount of money, but not a lot out of this structure. So the way these things worked before was that shareholder would incorporate holdco, and holdco would incorporate two subsidiaries. Subsidiary one would be called investco, and it would have all the investment assets. Subsidiary two would be called opco. It would own all the business assets. Opco every year would carry on the business. It would earn more than $500,000 of business income, and all of the business income in excess of $500,000 would be general rate business income. And would be full rate taxable income, and we are subject to tax at the general corporate rate of 23%. And fine, it would also be added to a pool called GRIP, which we haven't talked about yet, but we will in the next unit. And so OPCO would pay out an amount equal to its GRIP every year. And so the GRIP moves up to HoldCo. And what GRIP does is it allows you to pay eligible dividends to your shareholders. And we're going to see how that works later. But eligible dividends, and again, we're going to see this later, get taxed at a favorable rate relative to other taxable dividends. And then what happened in Investco is Investco would earn its investment income. Let's say it had a bond portfolio to make things easy, so it earned interest income. And so it would pay dividends to HoldCo to recover its RDTOH. So it would get a dividend refund. HoldCo would have Part 4 tax, which we're about to talk about, which basically would equal the dividend refund that was received by Investco. And then HoldCo would pay an eligible dividend using the GRIP it received from OPCO to its individual shareholder. And as a result, HoldCo would receive a refund of its RDTOH as a result of paying that dividend. So the result is that since effectively the dividend recovered the RDTOH, which is the refundable portion of the corporate tax payable on the investment income earned by Investco, to use current year numbers, we would have had net tax payable on the interest income in Investco of 16%. And we would have had tax on the dividend that was paid using current year rates at 34% on the eligible dividend instead of the normal non-eligible dividend rate of 42.31%. So you have, you've got, in this example, $80 of dividend at 34%. And so whatever that worked out to with your 16% non-refunded, but it came to, reasonably under the top marginal rate of 48%. And that was bad. And finance decided after notwithstanding that had been the case since 2006. Finance decided they didn't like this anymore in 2017, and they introduced the new RDTOH regime. And so what the new RDTOH regime does is it divides the RDTOH, what was formerly RDTOH in subsection 129.3, it repealed that and replaced it with two separate concepts. One is called eligible RDTOH and the other is non-eligible RDTOH. So the mechanics have broadly stayed the same, but what it does is it, as we're going to see in the next couple slides, it kind of prevents that purifier or washer transaction. So if we flip to slide 14, eligible RDTOH is the very limited pool of these two. And what eligible RDTOH does is the only way you can ever add an amount to eligible RDTOH, aside from on the introduction of the regime, where there was a one-time addition on the conversion under subsection 129.5. But generally speaking, the only way you can ever add an amount to eligible RDTOH is if it's as a result of Part 4 tax, which again, we're about to talk about what Part 4 tax is. But and I mean, I hope as you're listening to this, you're understanding why I have been trying to teach us using the old RDTOH regime, because until you know how corporate distributions are taxed and how Part 4 tax works, none of this is probably making a whole ton of sense right now. So, you kind of have to teach it using the old rules until everybody has a better view of the entire field. And you're probably not going to have a better view of the entire field until we're basically at the end of the course. So you either have to not teach this until the end of the course, or you have to teach it in a logical order, but teach it using the old rules. And it's kind of very inconsiderate of the Department of Finance to change the rules like that. But anyway, eligible RDTOH. Effectively, the only way you can add an amount to eligible RDTOH is if the corporation has paid Part 4 tax in one of two circumstances. One, it has received an eligible dividend from a non-connected corporation. We're going to talk about what connected corporation is or is not, so don't worry about that. But you've received an eligible dividend from a non-connected corporation, or you have received a dividend, and may not necessarily need to be an eligible dividend, but you've received a dividend from a connected corporation, and that dividend resulted in a refund of eligible RDTOH to the connected dividend payer corporation. So again, recognizing we haven't talked about Part 4 tax and Section 112 sub 1 yet, think of it in a really simple form that if you acquired a bunch of shares of, let's say, Royal Bank in your private corporation, you are not going to be connected with Royal Bank because you are never going to, none of you, I'm just going to go on a wild limb, none of you are ever going to be rich enough that you are going to own more than 10% of the votes in value attached to all the shares of Royal Bank. If you are, either you are spectacularly wealthy and not very diversified, or something has gone very badly wrong with the Royal Bank of Canada, and we are probably as a nation screwed. So, that would be it. So you would own shares of Royal Bank. It's not a connected corporation. Every dividend the Royal Bank of Canada pays is going to be an eligible dividend just because of what it is. And so as a result, when you have Part 4 tax, which again, we're going to talk about, the Part 4 tax would get added to eligible RDTOH. And it would be refundable to the recipient private corporation upon the payment of eligible dividends to the private corporation shareholders. Non-eligible RDTOH, we've slipped to slide 15. Non-eligible RDTOH is basically everything that's left in old RDTOH. If it wasn't carved out into eligible RDTOH, it's everything that's left. So it's refundable tax paid on aggregate investment income. It's Part 4 tax paid on non-eligible dividends received from non-connected corporations. It's Part 4 tax paid on dividends received from connected corporations that did not result in a refund of eligible RD2H for the connected corporation. So all of that stuff that goes into non-eligible RD2H. And so what has happened as well in conjunction, and again to go back to Jacob's question earlier, in conjunction with that switch from the old RD2H to the new eligible, non-eligible RD2H regime, there was also an amendment to subsection 129.1. And what subsection 129 sub 1 now says basically is that in order to recover in order to recover non-eligible RD2H, you can only receive a dividend refund for non-eligible RD2H when you pay a non-eligible dividend. You can recover eligible RD2H by paying either an eligible dividend, or if you pay non-eligible dividends in excess of your non-eligible RD2H balance, you can recover eligible RD2H using a non-eligible dividend, which you really probably shouldn't do that. I'm sure there's some situation in which that would make sense to do, but I'm not really sure why you would. It's not coming to me right now, but I'm sure there's a situation where it would make sense to do that. But by and large, the way to think about it is eligible dividends will recover eligible RD2H, if any. Non-eligible dividends will recover non-eligible RD2H, and if there's any unrecovered eligible RD2H, we'll recover that as well. So between those concepts, the change to 129 sub 1 and the separation of RD2H into pools, we've killed those corporate mixer type transactions at the cost of some not inconsiderable added complexity to the Act. So I actually lied. We're not going to talk about Part 4 tax right now. I had moved that. So we're going to talk about Part 4 tax. In fact, in, I guess, a couple weeks, reading week is next week, isn't it? So I don't think we have class next week. So we're going to talk about Part 4 tax in 2 weeks, I guess, or 3 weeks. I think we talk about capital dividends first. Yeah. So you'll have to wait in suspense for Part 4 tax. Just know that it's there, and it backstops the refundable tax regime. Okay, so does anybody have any questions about corporate investment income generally, or anything we've talked about today? Okay, seeing none, let's flip over to slide deck number 6. Now let's get started on this. This one is one of our 2 biggest blocks of stuff. So let's get started on it and see how far we can get into. We're certainly not going to finish it today, but hopefully if we get a good way into it, we'll make sure we finish it off whenever our next class is. So starting off on slide 2, what the handouts talk about at handout 12 is it kind of shows you how there's distinctions between debt and equity distributions that are made by corporations. At a practical level, they're treated differently, as the handouts allude to. At a theoretical level, there's a lot of debate always in the tax community about whether debt and equity should be treated differently for tax purposes. As we're about to see, the Act creates a distortion. It favors corporations paying interest because they get a deduction in computing their taxable income that they do not get for equity or for any kind of implied return on equity. And so that creates an incentive to have a more debt-heavy capital structure than would probably otherwise be ideal given the risks that are created by debt-heavy capital structures. And really it's the market that will be the ultimate constraint on the capital structure, and with tax creating an incentive that moves your corporation's tolerance past what the normal market tolerance would be. There is always some debate about whether we should replace interest deductibility with a concept of just a deduction for a return on corporate capital, and that would apply to both debt and equity at some arbitrary rate that would look a lot like a risk-free return on capital. There was some discussion of this in I think with the most recent edition of the CTF's Perspectives on Tax Policy newsletter by Michael J. O'Connor. So you might want to give that a look. It gets discussed a lot in tax academic circles. I don't think that anything will ever come of it unless many of our major peer states start to move in a similar direction. But like something to think about. But the moral of the story, though, is for corporate tax purposes as the law exists today and probably will exist for the foreseeable future, debt and equity are treated very differently for tax purposes. And so it becomes very important to distinguish between debt and equity and figure out whether you've got a debt instrument or an equity instrument. There is some case law and there are some administrative pronouncements that will help you distinguish between debt and equity. I don't think we want to talk too much about them because some of these distinctions get very complicated. There's it's actually a series of cases called Borreo Holdings from the Tax Court and Federal Court of Appeal that kind of get into a discussion about what are the fundamental characteristics of debt and how do you distinguish between debt and equity. My colleague Byron Beswick has written a couple papers where that gets discussed in most detail. He and Jim Samuel wrote a paper for the CTF in 2019 for the annual conference that has a discussion about debt equity distinction. So if you're really curious, that would be a good place to look. Suffice it for the purposes of this course to say that my view is that the primary distinction between debt and equity is in classifying an instrument is whether the instrument gives the holder the rights of a creditor in the event of non-payment when due under the instrument or in the event of any other kind of default under the terms of the instrument. Obviously, for Canadian tax purposes, form matters, but it's the legal substance that really matters. So just because you call something a debt or you call something an equity instrument doesn't make it so. It's really just a matter of what the actual legal substance of the instrument is compared to what the courts have decided is a debt or is an equity instrument. For the purpose of this course, let's assume that nomenclature always describes accurately the legal substance. So if we call something a debt, it's a debt. If we call something a share, it's a share. If we call something a non-debt, non-share equity instrument, which I don't think we're going to talk about in this course at all, because I'm not cruel, then we can assume that's what it is. So with that introduction to distinguishing between debt and equity, I think we've come to a reasonable point for a break before we start to dive into what happens with debt and what happens with equity. So we'll pick that up when we come back. It's 2:55, give or take. I'm going to stop recording and let's come back at 3:05 p.m.